Solventum real quick, and I could probably tell you about this company by showing what they do. First, they were a spinoff from 3M. 3M is a high quality company. I certainly believe that. I think most people that have been in the business world really respect 3M. They've had their issues. They released some earplugs. They sold earplugs that caused hearing loss for some servicemen and women, which is really bad. But I don't think they meant to do that. And they've resolved that through the legal courts and have paid the money that they should have paid. So that being behind them, they decided to really focus their business, which was a good idea. And they spun off Solventum. Solventum focuses on providing products for healthcare, for surgeries, for hospitals to use. They also have systems that hospitals use to manage the operation and maybe the billing. They also do dental products. So your dentist, when your dentist is working on your teeth and so forth, they might be using Solventum products, which were previously branded with 3M. Now, the company was a spinoff, and it's coming from a quality company, in my opinion, and it's being spun off. Now, some spinoffs have been really, really good. Some spinoffs, not so good. Now, my biggest concern with the company was I didn't have enough data. Everything was being communicated as this is what we think we're going to do. So I wanted to give it a quarter or two because I was given shares because I'm a 3M stockholder, and I sold my shares and said, I need to see some data before I make a decision to buy more shares and even hold these shares. So what I'm going to do is we have the financials from the quarter that just ended. It was reported about a week ago. So let's put this guy on half a screen. Let's get the valuation model. This is for Solventum, and it'll also tell you kind of like how I think about it, right? Solventum is new. It's not as well known, so I'm going to increase the discount rate. I want a higher rate of return because it's an unknown company to this point. It's really unknown how much they're going to grow, but it's going to be modest growth. I'm going to leave these factors here alone. The growth rate and cash flow, this is healthcare, right? Healthcare is steady. Healthcare is really nice and steady. I'm going to play it safe, 5%. I'm going to leave it at 4% for long-term growth of my cash flows. Now we're dealing with a key input into my model. I value companies on cash flow, and I value companies on earnings per share. Real quick, I value companies on cash flow because the top most valuable companies, if you look at them, they produce high cash flow, and they've shown a track record of growing their free cash flows. That's why Apple's worth $3.4 trillion. And the second player, Microsoft, look at their cash flow. That's why they're worth more than $1 trillion. So I use cash flow. So let's take a look at Solventum's cash flow. I'm going to reduce this guy to a smaller position. So this is cash flow for the first 6 months of their current year. And it's cash flow is cash from operations minus plant, property, equipment, which is CapEx. And the reason there's logic in that is the business produced all this cash that the owners get to use. They can use it for dividends. They can put it on the balance sheet. They can acquire other businesses. They can buy back shares. But CapEx represents how much money they have to put back into the business. So it'd be like owning, a business, let's say a pizza shop. Now, at the end of the month, your pizza business, or at the end of the quarter, your pizza business gives you $2,000 or $5,000 in free cash. But every end of the quarter, you got to buy a new oven. And then the next time you got to buy this, you got to buy the other. It's almost like you're recreating the business every year. That's a bad business. But if you have very little CapEx, that's a very good business. If you have high cash flow, low CapEx, that is Google Alphabet. That's Microsoft. That's Apple. So that's why we want that ratio to be high operating cash flow, low CapEx. In this case here, it's 797 minus 160 for the first 6 months. So that's for the first 6 months. So I'm going to do the formula here with you. Hopefully you guys could see it. And I'm sorry if it's a little bit hard to see, but I'll talk you through it. So we got $797 million minus $160 million. That's for 6 months. So I'm going to multiply it times 2. So that's for the year. For the year, I'm expecting they're probably going to do about $1.2 billion in free cash flow for the current year. I'm going to leave it there. I'm not going to increase it just to play it safe. And these numbers are going to be growing at 5%. So the forecast is they're going to do $1.2 billion for the first year. Then it's going to grow by 5% for the years 2, 3, 4. Terminal values, all cash flows beyond year 4. Those are going to grow at 4%. I'm going to discount. This is like saying they're going to deliver all this cash to you. And let's say you were the sole stockholder of the company. You'd get all that cash. The net present value of all that future cash is going to be determined by discounting it based on the rate of return that you want on this stock. In this case here, I want 9%. And based on a 9% discount factor, we get an intrinsic value of $24.3 billion. That's what the company is worth based on the free cash flows I expect the company is going to produce. Now we need to know how much cash do they have on hand? Well, they gave us a financial statement. So we got the balance sheet. That's where we know how much cash they got. Cash and cash equivalents, $897 million. All right, we can pop that in there. How much debt? Debt's important. Long-term debt, $8.3 billion. And then they have any in the current. Nope. So we got just $8,306 million. That's how much debt. So the present value of all the cash flows I expect plus the cash minus the debt is the equity value of this company. That's what that company is worth to me. Now, when I look at Solventum and I look at their current market cap, they are a $10,160 million company. All right. Shares outstanding is they've got 172.71 million shares outstanding. So the intrinsic value per share is $98. Their current stock price is $58.84. So there's a 67% discount on this stock. If we look at the cash flows that they're going to produce and we want a rate of return of 9%, it gives us a discount of 67%. Cash flows. Cash flows, number one method that most investors use. Warren Buffett, Charlie Munger. You look at those types of Pat Dorsey, read his book, Cash Flow is King. Now, I also like to look at earnings per share, and I weigh that with free cash flow method because sometimes a company has tremendous growth in earnings per share, and temporarily their cash flows are low, but eventually they'll be high. With this company, it's expected they're going to do $6.36 in the current year. All right, so let's put that in this formula here, $6.36. I'm not going to give them a PE of 24. They're too young and unproven. They are growing. They showed growth in their financials. They grew slightly. So I'm going to go with like 16. I like their industry. I like the fact that they are in healthcare, which I believe is going to do well going forward. I like a lot of attributes with Solventum. And the current stock price is 58. So there's actually a big discount if we look at earnings per share. We can even lower the earnings per share to 12, which is really, if you read Benjamin Graham's book, is if you have a company that's profitable, producing cash flow, growing, it deserves at least a 12. Sometimes the market just discounts a stock beyond reason. But in this case here, we are looking at a stock that is discounted, blended at 55. My blend is this way. I take two parts. 2/3 of the valuation is free cash flow. 1/3 is earnings per share valuation, 55% discount on Solventum. All right. So we know it's discounted, but do we want this business? Do we think this business is good? Right. So let's talk about Solventum. So Solventum are they highly desirable, okay company, or not desirable? Highly desirable is, hey, these guys, they got competitive advantages. They can keep competitors out, therefore grow really well, be profitable, and generate a lot of free cash. Okay, that'd be the green. That'd be like Microsoft. That'd be Google Alphabet, Amazon. Those guys are super strong, great barriers. Or are they just kind of middle of the road? They do have some advantages, but overall, just not tremendous advantages. Or are they on the red? Hey, it's a donut shop. Anybody can open it. You got competition everywhere. Prices are really low. Profits are really low. No cash flow to really speak of. I think that Solventum is probably clearly in the gray. And you could argue, yeah, they're in the gray, but you could also say that they're probably crossing over into the green because they do have some patents on some of the med devices that they have for surgeries, dental practices. The other thing that you can argue that, they belong partially in the green is that their relationships with dentists, that kind of like the network effect, the relationship with hospitals, doctors and hospitals are accustomed to using Solventum products for surgeries, and they don't like changing that stuff all that often. So they have stickiness in their business. So if they can start growing, I could definitely see them. Hey, it's going to be very hard to replace Solventum. They got established relationships, that focus in the company of, hey, they're a spinoff from 3M. That real focus on med device is going to really help this business. So I like Solventum. I like the discount at 55%. I like the pedigree of the company that they came from 3M. So I'm going to be buying Solventum stock going forward. I'm going to put a nice buy order in on this company. And just start building a position. Back to how much I'm willing to invest in Solventum. For now, I'm willing to bet $5,000 to $10,000. I'll build the position up. I like starting with about $1,000 investment and then building it up from there. I'm going to put Solventum in my portfolio. There's mostly income-based stocks because this stock will eventually pay a dividend and it'll be the right place for it. So that's how we got to a valuation on a company. The company hasn't existed that long. They were issued out as spun off less than a year ago. So far, down 35%. I think people are waiting to see what the heck the company's about. The last month, man, they're rocking. Look at them go. Last 5 days, down a bit. Man, you know what? I'm going to buy probably tomorrow. Unless the market, if I wake up and they're like, oh yeah, Solventum's up 10%, then I'll be like, man, I'm going to have to wait a little bit. So that's where I'm at with Solventum. I like the company. I've been tracking it for some time. I knew the spinoff was coming a year ago. It happened. I've got enough data to be comfortable. I think a 55% discount is going to be potentially rewarding enough for me to take the chance and buy stock in this company.